The screens are flashing red, headlines scream panic. Bitcoin, Ethereum, and the entire crypto market are in freefall. For many, this is a moment of fear and regret, as portfolios shrink and doubts about crypto's future resurface. Social media and news amplify the panic, creating a feedback loop of negativity. But this chaos isn't random. It's a recurring pattern in crypto's history, a necessary reset. These crashes shake out weak hands and set the stage for the next rally. To understand what's really happening, we need to look beyond price charts and examine the global forces at play. This downturn isn't the end. It's the setup for what could be the greatest macro trade of our lifetimes. In the world of crypto, there's a near constant buzz about the Bitcoin halving. Every 4 years, the event is hyped as the key to understanding Bitcoin's price surges and the wild swings of the market. But if you look deeper, you'll see that the halving is just one piece of a much larger puzzle, one that extends far beyond the boundaries of digital currencies. The real engine behind these massive market cycles isn't just a technical event coded into Bitcoin. Instead, it's something much more fundamental, something that shapes the entire global financial system. It's not just about crypto. It's about how all markets move together, in sync, through booms and busts. I call this force the everything code. It's my framework for understanding markets, and it centers on the global business and debt refinancing cycle. This cycle is the heartbeat of the financial world, quietly pulsing beneath the surface, influencing everything from stocks and bonds to real estate and digital assets. Every few years, trillions of dollars in debt come due across the world. When this happens, central banks and governments face a stark choice: allow a financial crisis to unfold, or step in and print more money to keep the system afloat. Time and again they choose to print, flooding the system with new liquidity. This fresh wave of money doesn't just sit idle. It rushes into assets of all kinds: stocks, real estate, commodities, pushing prices higher and higher. Investors, searching for returns, pour capital into anything that seems scarce or promising, fueling new bubbles and setting the stage for the next cycle. And in recent years, this tidal wave of liquidity has increasingly found its way into digital assets like Bitcoin. Because Bitcoin is scarce by design, it becomes a magnet for capital whenever people fear that traditional money is losing value. The Everything Code is about recognizing these repeating debt cycles, understanding how currency debasement works, and seeing how these forces drive people to seek out assets that can protect their wealth. That's why, throughout history, investors have always searched for safe havens, whether it's gold, real estate, or now, digital assets. The search for safety is a constant, even as the forms it takes evolve. When you understand the Everything Code, market crashes stop being terrifying surprises. Instead, they become expected pauses in a much larger rhythm, a chance to reset before the next wave of growth. The Everything Code is your map for navigating these cycles. It helps you anticipate what's coming so you can make smarter decisions, not just react to headlines, but truly understand the forces shaping our financial future. To truly grasp the Everything Code, you must first understand the staggering scale and complexity of global debt. Across continents, governments, corporations, and individuals are borrowing at unprecedented levels, creating a vast web of obligations that stretches into every corner of the world economy. This isn't just a matter of numbers on a balance sheet. Debt shapes the very foundation of modern finance, influencing everything from interest rates to the value of your savings. The sheer magnitude of what is owed today dwarfs anything seen in previous generations, and it continues to grow year after year as new loans are issued to pay off old ones. Every year, trillions of dollars in debt mature and must be refinanced, creating a constant cycle of borrowing and repayment. This relentless churn makes the entire system fragile, like a Jenga tower stacked ever higher. One wrong move, and the whole structure can come crashing down. The pressure to keep refinancing grows as debts pile up, and the risk of instability increases with every passing year. When interest rates rise or the economy stumbles, the cost of servicing this mountain of debt can become overwhelming. Defaults and bankruptcies threaten to trigger a chain reaction, spreading crisis from one sector to another and even across borders. The consequences can be severe: lost jobs, shuttered businesses, and entire communities left behind as the financial system struggles to cope. In these moments of stress, central banks step in as the lenders of last resort. They lower interest rates and inject new money into the system, using powerful tools like quantitative easing to keep credit flowing and prevent a total collapse. This intervention is designed to stabilize markets and restore confidence, but it comes with significant side effects. Quantitative easing in particular floods the financial system with liquidity, making it easier for banks and businesses to borrow. This process can stave off disaster in the short term, but it also encourages more borrowing, adding fuel to the debt machine and making the system even more dependent on easy money. But every new dollar printed dilutes the value of those already in circulation. Over time, this leads to inflation. Your money buys less, and the cost of living rises. The purchasing power of ordinary people erodes, even as asset prices soar. This relentless debasement of currency isn't the result of a shadowy conspiracy. It's simply the mathematical reality of our monetary system. The numbers don't lie. As debt grows and more money is created to service it, the value of each unit inevitably falls. The result? Scarce assets, like Bitcoin, gold, and even fine art or real estate, become increasingly attractive. As fiat currencies lose purchasing power, people seek refuge in assets that can't be easily printed or inflated away. This is why Bitcoin, with its fixed supply, has captured the imagination of investors worldwide. The global debt machine is more than just a background force. It's the engine driving the long-term rise of crypto and other scarce assets. Understanding its influence is key to navigating the future of money. When central banks print money, they inject fresh liquidity into the financial system. This new money doesn't just sit idle, it actively seeks out the best possible returns, flowing through banks, investment funds, and eventually into the hands of investors and consumers. The result is a powerful ripple effect that touches nearly every corner of the economy, from traditional markets to emerging sectors. As this liquidity spreads, it lifts the prices of almost all assets. Stocks surge, real estate values climb, art and collectibles become more coveted, and anything with a limited supply becomes even more desirable. Scarcity becomes a magnet for capital, and investors look for places where their money can not only be preserved but also grow. This phenomenon is often described as the liquidity lifts all boats effect. Just as a rising tide raises every boat in the harbor, an influx of money from central banks tends to elevate the value of nearly every asset class, regardless of its fundamentals. Bitcoin, with its mathematically fixed supply, stands out in this environment. Unlike fiat currencies, which can be printed at will, Bitcoin's scarcity is hard-coded. This makes it a kind of digital black hole for capital, drawing in value as people look for safe havens in a world awash with ever-increasing money. The data shows a strong correlation between global liquidity and Bitcoin's price. When central banks expand their balance sheets, Bitcoin often rallies. This isn't a coincidence, it's a direct result of capital searching for assets that can't be diluted by policy decisions. As fiat currencies lose value through inflation and debasement, investors and savers seek refuge in assets that are immune to the whims of central banks. Gold has played this role for centuries, but now digital assets like Bitcoin are increasingly seen as a modern alternative. Of course, this comes with a price. Crypto markets are famously volatile, swinging wildly as they react to changes in global liquidity and investor sentiment. But this volatility is the cost of being at the epicenter of such a powerful macroeconomic force. Market crashes and corrections often follow periods when central banks tighten liquidity, pulling money out of the system. Yet, because of the persistent debt problem in the global economy, central banks are almost always forced to reopen the spigot, flooding markets with liquidity once again. For those who understand these cycles, every dip has historically been a buying opportunity. By keeping a long-term perspective and recognizing the bigger picture, investors can position themselves to benefit from the relentless tide of liquidity that shapes our financial world. When liquidity dries up, fear takes over, losses mount, and panic selling begins. Social media becomes an echo chamber of doom, amplifying anxiety. This is the point of maximum financial opportunity, but also maximum psychological pain. Most investors fail here. They buy the hype at the top and sell the fear at the bottom. The smart money accumulates from the panicked herd. My advice, do nothing, or if you have conviction, buy when others are fearful. Turn off the noise, focus on your thesis, and remember the everything code. If the debt problem persists and central banks keep printing, the long-term trend is intact. The crash is noise, not signal, opportunity. not disaster. In turmoil, zoom out. Short-term dips are blips on a powerful long-term uptrend. Crypto's adoption curve is faster than the internet's, with billions coming online. This is a secular multi-decade trend, not a passing fad. The everything code, blockchain's revolution, and a generational shift in trust are converging. These megatrends create a reflexive loop of adoption and value. Today's pain is tomorrow's opportunity. Smart money looks forward, not backward. Financial conditions are already turning, setting the stage for the next expansion. The groundwork is being laid for a new bull run. Those panicking now will be chasing higher prices soon. Every cycle ends with the banana zone, a period of explosive parabolic gains. This frenzy is triggered when global liquidity finally floods into crypto. The current consolidation is building the base for the next big move. Debt refinancing in 2026 to 2027 will force central banks to act, fueling a potential supercycle. If you wait for confirmation, you'll miss the move. Position before the frenzy starts. Now is the time to prepare. Hold your core positions, have a plan, and resist overtrading. The goal isn't to catch every wiggle, but to ride the coming wave. The next banana zone could be the most powerful yet. Even with a strong macro thesis, it's vital to listen to experienced voices like Brandt. Peter focuses on charts and risk, not predictions. He sees cycles, not certainties. He notes that each Bitcoin cycle's returns are diminishing as the market matures. This tempers expectations of endless explosive gains. Peter's approach is about capital preservation and avoiding ruin, even in bull markets. His caution complements the everything code, reminding us to manage risk and avoid euphoria. Listening to both perspectives keeps us grounded and prepared. We're at a crossroads. Fear dominates, but the macro picture is bullish. The key isn't a magic formula, but a robust strategy, conviction, patience, and risk management. Write down your thesis and let it anchor you through volatility. The greatest wealth comes from holding through cycles, not chasing pumps. Accumulate quality assets during fear and hold for the next banana zone. Manage risk. Don't overexpose, diversify, and respect the market's volatility. Combine macro understanding with discipline, and you'll thrive in the opportunities ahead. The code is written. Follow it.